Get started in just a minute. Lloyd, I guess whenever you want to start, we can. It's right at 7.
Okay, you got everybody in?
I'm letting them in as we speak, and I'll continue.
Okay.
So,
I'll go ahead and start then. My name is Lloyd Allender, and you are here at the May meeting of St. Louis Real Estate Investors Association. And we're live from St. Louis, Missouri. Surprise. But not everybody that uses St. Louis in their name is live from St. Louis. So
yeah,
I would just give you a warning about that. Anyway, welcome everybody. We got a great program for you tonight. We have Beth Kullmann from Guild Mortgage. She comes very highly recommended from one of our board members. And she's going to fill us in first on the state of the lending, commercial lending or resident investment property lending market and what's going on now. So there are a lot of things changing in the marketplace. And then after, we're going to have Laura Lennington on, one of our longtime valued members. So I'm going to turn over to Beth right now and have her give her a little presentation. I hope everybody can see her presentation on your screen right now. Go ahead, Beth.
hello everyone. Thank you for having me this evening. I'm going to talk to you a little bit about investment property purchases and refinances and the recent changes that Fannie Mae and Freddie Mac made to their purchasing and backing of those specific type of loans. They have really kind of put their foot down and kind of changed their entire view on how they are purchasing them and how they are servicing them. So I'll kind of go through that with you guys a little bit. This is mainly Fannie and Freddie. FHA and VA do not really, they don't do investment properties, so it doesn't really affect them. And of course, a private bank doesn't normally sell their loans to Fannie and Freddie. They just portfolio them and they service them themselves. So this is kind of specific to Fannie and Freddie if you're looking on the secondary market. So this is some information that I have from, we have a gentleman that works for Guild. His name is David Batney, and he is the Executive Vice President of Emerging Markets. He is very, very knowledgeable. He's a little dry. So sometimes, you know, he gets going on something and I kind of get lost, but I do read the update he sends us every day and make sure that I understand, you know, as much as I can about what's going to happen and the relationship between everything and the stock market. You wouldn't think that everything is related to the stock market and thus to bond prices, but it is. And he really does a good job of kind of putting that all together. So, so my first slide is about the impact on investors. Fannie and Freddie announced, and really without notice, that they were going to restrict the amount of loans that you could deliver that are second homes and investment property. And they have restricted that amount to 7%. For Guild, our normal monthly sale to them is about 11%. So we had to really kind of scale back, as did, you know, Bank of America, Chase, everybody that's selling to them, because everybody was over 7%. And so what that means for an investor is if you are in the middle of purchasing a loan or you're refinancing a loan and the bank that you're, you know, going with, or the mortgage company that you're going with, they might get stuck with that loan. They might not be able to sell that to Fannie and Freddie. If their numbers go above 7%, then they're going to have to hold that loan until such a time that they have the ability to put that into a portfolio for sale. They used to call them delivery commitments, which is what I still call them. And so sometimes Fannie and Freddie will take, I don't know, like a $20 million delivery commitment, and the investor needs to fill that and deliver that, because that's what they have said that they would deliver. And pricing is based on those type of delivery commitments. So that's kind of how they get a little bit of a leg up on other people. So So like I said, so they started in April, and the kind of problem is that what's going to happen when you have to hold on to a loan, when you have to finance it yourself. So, so like for Guild, our portfolio is about 60 billion that we service. So if we've got, 3% of loans that were originated, that were investment property and second homes that we can't sell, we've got to have the cash for those. We have to have the liquid money to put those out on a line somewhere. So either we need to borrow it from the Bank of New York, we have to borrow it from another type of investor that will take the loan. And a lot of those investors have seen dollar signs and they're like, okay, hey, you've got 3% of loans that you cannot sell. We're going to buy them from you, but we're going to buy them at a discount. So instead of paying you dollar for dollar, we're going to pay you 70 cents on the dollar. And so what happens to Guild or to other, larger companies is that they end up losing money to get that property off their books. And so that is kind of the big, that's kind of the big thing is that, how much money can you as a company lose to move those loans off your books? So the first kind of knee-jerk reaction was that they were going to hit the rates high and the fees, and so that people stopped buying investment property or refinancing it or doing second homes, which doesn't really work, in places like Lake of the Ozarks or, there's places in down by the, on the coast, people are buying second homes there. And so for them to be expected to pay, 6.5%, 7% rate, that's really hard. And people start to not be able to qualify. The payments get to be too much. So the Mortgage Bankers Association went to Washington and really kind of got in their face a little bit and said, hey, this is not fair. And so Fannie and Freddie, they backed off just a little bit on purchases only. As far as refinances go, they can hit whatever points there were. And the market isn't always just about points that you see. It's not like a discount point. Sometimes if you're gonna, let's just say, get 3% rate, there's a yield on that. And that yield is the same thing. It's a point, which is 1%. Some of the yields went up to 10 points because they didn't want the loans and because they couldn't sell them. And so it's a really negative for borrowers. Like I said, luckily they've backed off on the purchases. They have not, now that they have bumped them up probably 2% on the yield, which still makes, I have a purchase right now of a person buying an investment property in St. Louis, and their rate's going to be 3.99. When last year it could have been, 2 and 3/4. So it's still a significant change. And so you kind of have to just look out for that. The Mortgage Bankers Association is still trying to get a hold of people in Congress, get them to sway the other way, but it's slow. And there's a lot of online different places you can go and register and say that you're not for that and you want them to reconsider. And like I said, the other thing is that Fannie did not give any notice. So normally, if they're making a change, they give us 60 to 90 days on actual delivery time, but it was effective the day after they announced. So anyway, so like I said, that definitely puts a damper on a lot of these programs. Fannie and Freddie both, like I said, did this. They feel like the delivery caps are new norms. They're only going to do 7%. And in some areas, they're going to drop that, which is interesting because when they came out with the 2020 numbers, there was some there were some problems with people who had investment properties who couldn't afford to make their payment because their renters weren't paying, or et cetera. But for the most part, second homes performed very well. They had very few defaults. And for as much as it was really difficult for people who were investors, they performed much better than they had anticipated. So, so there really wasn't, a huge impact for them to grab and say, oh my gosh, we gotta stop this right now. So people didn't really know where it came from. So like I said, 7% of the mortgages, and then you kind of get into people who float the market, who want to think about rates. They think they're going to come down. The rates haven't come down in the last 4 months. You might get a day where the yield slides down a little bit, and that allows you to get a little bit of a lower rate, but the rate's actually coming down. It has not happened. And it used to be a bad day on the stock market was a great day for rates because everybody was buying mortgage-backed securities and bonds. But that hasn't happened either. If it's a bad day, it's a bad day. There's really no kind of rhyme or reason like there used to be. Different people, Janet Yellen and, the Fed chair and, Mark Calabria, they're saying, oh, we're going to think about it, but thus far they haven't. So if they're expecting the Treasury Department to kind of step in and tell Fannie and Freddie they can't do it, they're not. So I think that was the initial, hope, but that's not happening that way. So they just think it's going to be the new normal. And so that will, like I said, definitely reduce the amount of people, especially if you get like lake communities, like down in the Ozarks. We have a big branch there, and 95% of their business is second homes. And so, now their business, plus there's no inventory, but now it's really slid down. I think he said, he's doing about 50% of what he did last year. So you'll see this kind of still affecting the market. Here's my disclaimer. This is the market update. Like I said, I'll give you guys copies. This is, Guild's EVP. It's his opinion. He's very knowledgeable. It's not always the way Guild runs, but, he does always have, pertinent information. So here's kind of the update that I got today. Obviously, I'm sure you guys know every day or every couple of days, there's some number coming out, housing starts or non-farm employment or, what the spending was or whatever. So today, housing starts came in worse than their expectation. They're expecting 1.71. They got 1.569. It kind of, he's always very, he's always very talkative about there's no inventory, and that builders had kind of backed off building for the last 5 to 7 years. And that's created a shortage in housing and, what people are buying and, the new age group to buy, first time home buyers are getting younger and younger because they have to put less money down. And so it's fairly simple for somebody who just got out of college to put down 3% on a $200,000 house. It's $6,000 plus some closing costs. They're into a $200,000 house for $10,000. So that's kind of, part of the issue is that there's just not enough housing. And, some builders went out of business. They never recouped. Bond investors are scared, and when they stop buying mortgage-backed securities, you're going to see the rates go up again. That's what's keeping them low right now, is that the government's currently buying them and keeping that money moving. And they're expecting that to stop. Here's kind of a graph just of 2011. You kind of see there was a big dip in 2019, and then it's kind of gone back up. But housing starts are not supposed to look like this. They're supposed to be a little more even, but like I said, building new construction has just been slow, and a lot of builders have been kind of affected by that. So then, like I said, there's some key words that you'll see. The dreaded word right now is inflation. Everything that they say, the Fed says, okay, we want to keep it at 2%. It comes out, it's, whatever it is, 2.2%. So the market is really watching what the inflation rate is going to be and what the unemployment rate is going to be. And they're really going to work really hard to keep that balanced, because if they don't, we're gonna have a lot of problems. Auto sales will be down. Home prices are gonna just kind of go down again. I hate to bring it back to like 2008, but it's not so much the loans that are gonna go bad, it's the value of the housing that's gonna go bad. Investors aren't getting the return on their money that they're expecting because of the current market trends being different than they were in the past. So they're looking to run their portfolios the way they used to, and that's not happening right now. Car manufacturers are, slower than they wanted to be. They can't get parts. And I know my brother-in-law ordered a Ford truck, a brand new truck, and he's been waiting almost 4 months for it because they can't get the parts to build it. So, and that's going to be what you're going to see also with this inflation. And this is what his opinion is that we're not going to be able to get parts to build, different things. And so warehouses are going to slow down. And then, people might get laid off or work less hours, or the only big warehouses that are doing great is Amazon. And past that, everybody else is still looking for parts. This guy, David, he was also an Eagle Scout. So he's always talking to us about what kind of knots they used to tie, and, what the different kind of knots it was. And he's always got a name for them. And so on this one, he talks about the Gordian knot and how hard they are to untangle. And I just kind of sit there and nod my head because I don't know about it. And then I look it up and look what it looks like. But that's kind of what he really compares it to a knot, is how many twists and turns and pulls that it's going to take to get that piece of rope straightened back out. And right now it's a lot. So, the market is a little bit higher on inflation than they thought. It impacts everything. And so now they're kind of linking it to COVID. And obviously the market was concerned with COVID. They talked a lot about herd immunity and how they were going to get this under control. And it was, obviously we had never been through a pandemic before. We really didn't know. So this is I just kind of took a couple of dates that he updated it. And you'll see that 5.5, they're talking about that, that there was, 1.45 million people had at least had one dose of the vaccine. That number continues to go up. I think they were expecting this herd immunity by June 1st to kind of show, and it really hasn't. And they don't know if that's because a lot of people only got one vaccine and they're not getting the second one, or if it's because there's so many people that aren't doing it. So that's slower. And then you'll see that's going to prevent schools from reopening, which will prevent some workers from going back to work. And it'll, kind of snowball. Hopefully in the fall, schools will really start to reopen, and then people will be able to get back to, their job and not have to be home with their children. And, that they'll be able to, help manufacturing get caught up and get things moving. So that's kind of the hope. Then here's another one. He talked about on 4/14 when they announced the pause of Johnson & Johnson, because it had, these blood clots. Part of his talk was that, that that amount of blood clots and that side effect is not uncommon in a whole bunch of other drugs. I mean, I know you guys have all seen the ads on TV where you watch somebody skipping through the park, and then at the end they give you like a whole minute of all these different, side effects and possible problems. And so it was the same thing, but because this was part of the pandemic, people just kind of stopped. And again, investors were worried about that. People who had invested heavily in Johnson & Johnson were going to start selling. And so that kind of created, a little bit of a downturn in the market too. And so again, this is just kind of his going through it. As the daily infection rates go up, the market watches that really closely. They also watch hospitalizations. And the CDC now, obviously has got approval for people 12 years and older. My brother happens to be the CEO and president of a hospital in Georgia. And they were one of the very first areas that had a huge hit. And so the CDC has been there, the whole time, testing people, and, it's kind of one of their markets. And, they talked about, about the people who are not getting vaccinated, and it's mostly rural areas. They're either not available or they can't travel that far. The rate is right now for vaccinated people, 2 shots is right under 50%. And so that leaves a huge portion of the population that either has got 1 shot or just doesn't want to get any. So that's going to continue to, wreak some havoc with the market, because they want everything to get back to normal. And so when that comes, then hopefully it'll be better. And the other thing is that, like I said, since mortgage-backed securities are still being bought, then, the government's spending money on those instead of, maybe more vaccines for rural areas, or, education, or, getting doctors to go to those areas. So them moving that money has also kind of had a negative, impact. As far as the delivery caps, with everything going on, the economists and the experts say there's really no end in sight. They don't expect Fannie and Freddie to just stop, and just go back to their 11, 12% of, delivery of second homes and rental properties, investment properties. They just don't see it happening because they deem it as too big of a risk right now. And so, like I said, if you're looking at a refinance of an investment property, say you want to cash out because you're going to buy something else, that rate's probably going to be 6, 6.25. And although that's not as high as, rates were obviously in the late 70s and early 80s, it's still much, much higher than it's been in the past, 15 years. So if you're looking to refinance and cash out to, expand your portfolio, it's not going to be pretty. So you might have to, come up with a bank or somebody else that can kind of loan you money at some better terms as far as that goes. And here's my disclaimer again, but that's basically it. Here's my contact information. I can, if you've got questions, I can, send you information that I get from, daily. I can, I have a rate tracker that's, so if I've got a loan I'm trying to track and it's a purchase of an investment property, 2-family, then I can tell you what that rate's going to be today. And it all changes daily. I know everybody knows the rates change, but the interesting thing is that when these markets have a larger bad day, they tend to change more than once a day. So sometimes you'll see them, they come out about 11, we'll get a change at 1:30, we'll get a change at like 4. So you can expect rates to definitely still be affected. So,
Okay, thank you, Beth. I was going to say, we can, if you got any questions, general questions, you can put them in the chat, or I see David Lee has got his hand risen already for a question. So why don't you go ahead, David?
Yeah, hi. Thank you, Beth. That was
Sure.
fantastic. Do you expect this impact, or do you expect this to impact primary mortgages, like for first home, like FHA? I mean, do you think it'll spill over into the other mortgage markets?
they're not expecting that. However, they have suspended some programs. So FHA has a 203K program, which helps first-time home buyers buy a property that might need some work. And then they can finance the work on it, if it's structural or a new kitchen or bathrooms or roof, whatever. Last year they suspended that. And, that's kind of a big program here. And then they've opened it back up just recently, but now the problem is it has to be organized by an FHA coordinator. And so the coordinators had no business last year, and now they're slammed. So right now, if you're looking for a 203K loan, you cannot find a coordinator that can do that loan for you. So I don't expect it to be the general population on a conventional loan, but some of the FHA products, the 100% programs, those might be affected just for lack of availability.
Okay, yeah, thank you. Anybody else got any general questions? I would say if you have something, a question maybe personally related to your situation with a current mortgage or something, Beth's got her contact information up there. Maybe just best to take that down and give her a call sometime during the week.
So Rick asked, are rates going up or just disappearing? I don't know. I think they're going to go up I'm just talking refinance right now because that's what the biggest thing is. They're just going up so that they're pricing some people out of the market, for if it's a 6.5% rate and, that's going to make your mortgage payment go up, a couple $100 a month. Some people are out of that. So I don't know that they can just stop financing those properties, but they're definitely slowing the trend to, I guess, protect themselves. Although, like I said, they performed very well. Let's look at commercial loans. So they do think there's going to be some effect on commercial loans because a lot of the companies and banks that do commercial loans are going to have to begin doing or do more second homes and investment property purchases. So they may have less capital to work with for commercial loans. How would
I got a question, Beth, if I can
Yeah.
ask.
Yeah.
I see a positive here. I mean, I know why it sounds bad, but if they're only hitting rentals and second home buyers. So if you're not a real solid on your rental issue, you're not going to buy, and that's not necessarily bad. And buying a second home, that's just a luxury. And if you're not well-to-do, then probably you don't need that.
Right.
And
Yeah.
the people that are doing cash on their own, they can just buy a whole bunch of houses really reasonable.
Yes. Yeah, they can. I mean, if they can find one right
Am
now
I
in the
missing
market. Absolutely. Let's see. Kathy says, how would banks decide who got 7% of those loans to go? So that's kind of a whole formula. And it has to do with the delivery commitment. So I'm just going to make up an example for you. So if Guild has a delivery commitment at, say, 5% for the interest rate for $35 million in investment properties where the borrower has put down 25% and their credit score is above 700. So there's kind of all these different little levels. So what you do is the big mortgage companies, they negotiate these, sometimes they call them coupons or delivery commitment based on that criteria. And so if Guild says, okay, we're buying $35 million, we have to deliver $35 million. If we don't, then there's a fine. And so sometimes if we're short or if, I used to see this a lot when we brokered out to Wells Fargo. Wells Fargo would be short on a commitment and they would send out, a special where they were, they reduced the rate by a quarter to get those kind of loans into the portfolio because they can make that adjustment better than they can pay the fine. So it just depends on your delivery commitment and if you're first in line with Fannie, and if you're waiting your turn and you can't hold them any longer, then you have to do something else. But it's all about the delivery commitment or the coupon, what the bank or the mortgage company negotiates with Fannie. So that's going to, I'm sure, change too.
Okay.
A question, can you hear me?
Yeah.
Yeah, good.
Not sure I followed all of this. Fannie and Freddie are refusing to underwrite loans. Is that what it is?
So
Certain-
no, so Fannie and Freddie don't underwrite the loans. What they do is they provide the money to the bank, in our case, Guild. So if you borrow $200,000 from us, that's not $200,000 off of, out of our account. We sell that loan to Fannie or Freddie, and Fannie or Freddie then pay us $200,000, and they hold the note and we do the servicing. So there's a lot of money in servicing. Won't lie to you. The first time I worked servicing, I couldn't believe it. But so unless you're at a bank, Midwest Bank, or a local bank, Regions, and they have a portfolio, if they have a portfolio, then that's their money that they're lending you. If it is Chase or Wells or Guild or Paramount or anybody big like that, they are just loaning you the money temporarily until they get it off of their books and onto Fannie and Freddie. So Fannie and Freddie back all the mortgages in the United States that are conventional. If that makes sense.
So they take all the risk and you make all the money.
Pretty much. Yep. I mean, it's kind of a simple thing. If you kind of think about this, I'm sure you all make your mortgage payments, so all mortgage payments are due on the 1st. That's the rule. And you have until the 15th to make it. And if you make it after the 15th, there's a late charge, right? Okay. The bank doesn't owe Fannie and Freddie their payment until the 30th. So they're holding, like I said, we're servicing, between 40 and 50 million, $40 and $50 billion, in any given month. We're holding all that money for 30 days, collecting interest on it, as well as interest on people's escrow accounts. That's some serious money. So that's where servicers make their money.
That's how you get rich in real estate.
Yeah.
With no risk at all.
Right. No risk. Right. So yeah, that's what it is. And then, the bank also gets private mortgage insurance if you put down less than 20%. That's also helping the bank make sure that nobody defaults. So should we wait?
So my fix and flip business isn't in danger.
I'm sorry.
I said my fix and flip business isn't in danger.
Probably not. So should you wait until the 14th to pay your mortgage? I mean, absolutely, you can. You have until the 15th to get your mortgage payment in. A lot of people base it on when they get paid, but that is a grace period on all mortgages, the 1st to the 15th. Get past the 15th, you're going to owe that late fee. But I see a lot of people who have lots of properties, and usually I get their bank statement so I can see how often they're eating at McDonald's, and I can see when they're making their mortgage payments. And most of them make it between the 10th and the 14th just to hang on to their money. Are you saying that credit scores will become more important in borrowing rates? Credit scores are always important unless you're dealing with FHA or VA, then it's really not as important. But if you are a borrower doing a conventional mortgage, the rates definitely get better as your score goes up, and usually it's like 20. So if you get 680, 700, 720, 740, 780, those are kind of the breaking points. And you'll see that pricing difference on those. You know, I priced one tonight. It's a young couple buying $200,000. Their mid score is 718. You know, I could have done about a quarter of a point better if their credit score would have been above 780. So definitely that. Will it hurt your credit score? Nope. So your credit score cannot be affected by your mortgage payment unless you are 30 days late. If you're due for your June payment and you don't pay it till July 5th, that's a 30-day late. That is going to be on your credit. If you pay your June payment all the way up till June 29th or 30th, that does not report. It is just late to the mortgage company. It's not late on your credit. So that does not affect it. And it doesn't help your score either to pay it early. So
Yeah, that's true too.
how about 800 plus credit scores? You know, I see them sometimes. I see them, you know, probably 805, 806. You can go up to 840. I don't think I've ever seen 840. 800 credit scores. So the best pricing is 780 and above. So there's really not another hit for 800. So 780 is kind of the top tier, best rates.
Okay, so we can, us 800 guys can slack off a little bit and still not.
Yeah, yeah.
Okay.
You can buy some more stuff.
I'm talking about Dwayne and myself, so.
Right.
Anyway, I appreciate you coming on with us, Beth. I hope everybody's got your contact information there, and if they got any personal questions, you can help them out with, maybe help them out with their next refinance if they get it in quick, huh?
Yep. Yeah, get done quick. So yeah, so I will forward you guys, I'll forward you a copy of this
The
presentation. if
Okay,
you want it.
super. That'd be great. Yeah, we can put that on our website. Send it to John. You got his,
Yep, I got all
you know,
John's information.
and we'll get it on our website. So anybody
Okay.
that missed our,
Can I get one more quick question
Sure.
you can say a quick question. Dwayne,
about,
please.
I'll ask it really quick, but Lois had talked about the commercial loans, and those aren't Freddie Mac, that's all internal to the bank type stuff. So it
Correct.
shouldn't be affecting those, and they change every year.
Right. I mean, I don't think it's going to affect the ability to loan on them. What we think it's going to do is it's going to have less money available to loan because they're going to start doing some of these loans for second homes and for investment properties. So instead of just doing commercial loans on their own portfolio, now they're going to expand to those other two areas and maybe use up some of the funds that they had normally done. You know, I've got that,
Mm-mm.
you know, we do a lot of business with Midwest Bank Center. One of the loan officers, they just kind of said right now they're not doing a portfolio loan. They need to get caught up. And so, I think you're going to see just a little bit of that. I think the little banks make lots of money and I don't think that they're going to stop doing it. It might just be a little time lag. Commercial loan interest rates to go up. No, could be.
I bet so.
Yeah, could be.
Yeah. I think so too.
The rates
Okay.
are on the rise.
Real appreciate your good information, Beth.
Okay. All right. Like I said, anytime you need something, let me know.
Okay, we will.
All right.
Thank you.
Have a good evening.
Okay, you too.
All right. Bye.
Bye-bye. Okay, we're going to move on to Laura Lennington. Next, our featured speaker for this evening.